the institution is what the institution accepts as its risk appetite allows some amount of risk. But the main thing with risk management is there should be no surprises. And unfortunately, with the pandemic and with the rise in interest rates in the US and other shocks that have happened worldwide, wars, unfortunately, there has been surprises, but nowadays, I think some banks and financial institutions have to be thinking holistically about potential shocks. So one of the most important things I think any financial institution can have is a risk appetite statement, okay? So it is the need to establish specific measurable goals and benchmarks for all risk. The goals and the benchmarks are the outgrowth, right? They're from your credit culture and your risk profile. Your credit culture can be your credit values, your beliefs, and your behaviors. And your risk profile is various levels of risks and types of risk on your balance sheet, okay? So let's talk about two different risk appetites. I want to give an example of what this is. One financial institution I worked with was in Bosnia and Herzegovina. And what they stated their risk appetite was that they wanted less than 1% loan portfolio risk over 30 days and no charge-offs. So that 1% portfolio risk over 30 days means they wanted 1% or less of their entire loan portfolio being over 30 days. And they wanted no loans charged off in a year. They wanted only 3% loan portfolio growth, very minimal. And they wanted what they called an acceptable profit level, meaning they weren't expecting to, make a huge amount of money, but they wanted to show a profit, okay? So they were a bit, we would call risk adverse. And I'll explain to you why, but let's talk about the other financial institution. The other financial institution was in the Republic of Moldova, and I worked with them. They looked at their loan portfolio. Now, again, these were lending institutions. Both were not deposit taking at the time. One has changed into a deposit taking institution, but at the time they weren't. So the one in Moldova, didn't talk about delinquency. What they said is we want a 90% recovery rate, okay? They wanted 15% loan portfolio growth annually, and they wanted a very high profit level, very high. Okay, so why did these two risk appetites come about? Sometimes you could look back at history. So what happened in Bosnia and Herzegovina, this is an institution I've worked with now over 13 years. I went in and started working with them back in 2010 after the big downturn in the economy, and they were in a shock. The investors hired me to go in and clean them up because I think at that point, we probably had 30% of our loan portfolio was delinquent. We ended up writing off, I think, about at least 20% of the portfolio, which they recovered significantly. But it was a shock. I think at least 1 or 2 months, we did not know if they were going to have enough cash to pay salaries. And so they swung to be very, very conservative in what they would accept in their loan portfolio delinquency. And also they were just conservative in their growth. This has changed because I think this risk appetite was a couple years ago, and now they've actually changed and accepted a little bit more risk. But this is historical, how the senior management has felt. I'll be interested to see if they still have this risk appetite in a couple of years, in 4 years, 5 years, if the management changes. But right now, they have a low risk tolerance, I would say. Republic of Moldova, this institution is new. They've never gotten, well, before the pandemic, they hadn't gone through any type of crisis situation. And they make only these small consumer loans, and they charge very high interest rates, and very high interest rates as you default. And they have a very, very strong collections department. So to be quite honest, it almost is like, I mean, they don't mind if you to miss a payment, because then they're going to charge you an increased interest on that payment you missed, and they're going to get your money. They were very good before the pandemic. Now the pandemic has changed this, and I think they've become less risky, but they were high risk, high return. And that was how their management and the board looked at it. Also, the board, the management, this was a public company that wanted to give out dividends also to its shareholders. So that's two different risk appetites. So let's talk about an overview of risk and where the risk appetite comes into. If we look at the top, it's kind of the risk-bearing capacity. Like, this is actually considering what circumstances could bring us down, bring the bank, the financial institution down. The second one is kind of where your risk appetite is then. So you think of your risk-bearing capacity, what can you accept? But then you look at what your appetite, what we want to accept. We don't want to go to the edge where we're almost bringing it down. We're making good profits, but everything is very high risk. No, there has to be a risk appetite where you can accept the amount of risk that you will have. You don't ever want to go to that edge, as we say. And this is decided by the board, okay? Or set by the board with management's input. So the appetite and the risk-bearing capacity is really thought of at the board level. Then you have your target risk profiles for the individual risks. And we're talking about credit, market, interest rate, operations, liquidity. And all of that is set by the management. But the risk appetite is mainly going to usually flow down, or at least going to be put, the board and the management works together as they think of the risk appetite, and will flow down to the individual risks. So let's talk about the statement of risk appetite. It is a board level document. It quantifies and qualifies the desired level of risk that your institution is willing. It expresses itself in limits or tolerance levels. It's normally refreshed annually. And it shouldn't be what I've seen the mistake with many financial institutions. It shouldn't be what you aspire to. It should actually state what is the tolerated risk appetite for the institution. So let me give you an example. This is not what you want to say. The company wants to be the largest financial institution in Ghana. No, that's not a risk statement. What you would want to say is the company does not accept risks that can result in a significant loss of its revenue base. Okay, so that is a risk appetite statement in green, and the red is something that you aspire to. And unfortunately, I see many risk appetite statements that are first draft generated that are more aspirational and not realistic of setting kind of these boundaries. So let me give you some examples of some benchmarks. So quantitative, I've seen, and these are examples from some actual financial institutions, mostly banks, that for earnings, we do not deliver a below market average of earnings as compared to the company's peers. So that is a comparison in this country of earnings compared that this institution, this bank would take to compare and say, we don't want to be below the average. We want to be average or above the earnings. Capital ratio should not fall below 6%. Now, qualitative benchmarks can be a little bit more difficult to develop, but let me give you a few. Manage growth effectively. Monitor early warning indicators of non-sustainability. So what this is saying is that the institution actually set up some early warning indicators of non-sustainability. And I think this is, I think if I remember, there were losses, they were, I think breaches and compliance, some other things, but they wanted to manage the growth effectively. They didn't want to grow too fast. So business activity, I saw one bank say, we're going to limit our business activities to retail and commercial lending. Okay. They didn't want to do any investment banking or anything fancy. They wanted to limit what they were doing. And the board set this This is what your business activities are going to do. So management, you can't go out and start doing some other crazy businesses that we don't want you to do. And there's always, I've seen in majority of risk appetites, a zero tolerance risk. No flagrant breaches, fines, or headlines. No breach of delegated authority. Okay, so there are always some areas in the risk appetite where they say this is what we will not tolerate at all. The board says we will tolerate this. So that is the risk appetite. I wanted to give it an overview, and again, I think it's a very important statement to work on. It's not easy to develop, but it's not hard either. So it takes time to craft it, but once you're thinking about all the risks and then you can formulate it, it actually is a statement that only needs to be refreshed every year to think if something's changed. Are there new business lines? Are there new geographic areas? Because sometimes I've seen banks say, no, we will not lend outside a certain area, a certain state in the US, or a certain country, or a certain region. So it just needs to be refreshed. Once you can get through the pain of developing it at the beginning, then it's something that would live with the institution. But again, it will need to be refreshed and reviewed every year by the board and management. So let's move on. I'm just looking at time to one of my favorite, I have two favorite tools, risk management tools I'm going to talk about today. And this one is called a risk matrix, and you're going to get an example of this. And this is something that I have implemented at, I would say, no less than 30 institutions. And it came from what I saw, what worked at my bank, at the bank's risk management committee. They used a risk matrix. So let me tell you what it is. It is a tool that is reviewed by the risk management committee, usually on a quarterly basis. That's the management level risk committee. Okay. It could also be, if you don't have a risk committee, it could also be looked at the management's executive committee. Okay. And the matrix is completed, and we'll talk about the development, by compiling information such as liquidity reports or credit inspection reports that will allow committee to assess the risk. And then the matrix summarizes risk priorities and directs attention to high risk areas or areas that the risk is increasing. And usually the matrix is going to be managed by a risk officer, but normally there's continual communication between the heads of departments. And also, again, it's always going to be looked at either if you have a risk committee at the management level or your executive committee. So let's dig in and see what this matrix is. Oh, one thing I want to state that just bounced in is the quarterly review is required of these risks, because risks are unique to each financial institution and they change over time, right? I mean, if we think of what the end of 2019 was, January 31st, 2019, and then what happened in March 2020, the pandemic started, and you can see that there can be major shifts in risk over even 3 months. So this is an aggregate risk profile. So if we look on the left, it's the quantity of risk, and then we compare it to the quality of risk management, okay? And again, I will give you an example, but I just want to show this to you. So if you have something that we would consider moderate quantity of risk and acceptable risk management practices, you would say it's moderate. If you have something that's high risk, but has, even with strong risk management oversight, quality of risk management, it's still going to be moderate because it's always high risk. Okay. And then we'll have, you say the risk direction in this area. Is it increasing, stable, or decreasing? Excuse me. So here's an example. This is an actual cut. I cut this out of a risk matrix from an institution I worked with a long time ago. And they broke out their activities. So the activities are broken out of segments. Okay. So you're going to have probably the different types of lending. let's say this institution had business lending. It also had a consumer lending. And then it also would break it out through like loan administration, finance, branch activities, HR, and usually compliance and regulatory. This is not a long document. At the most, I think it's going to be 2 pages at the most. Because you don't want to go granular. You don't want to go get too detailed. This is kind of a big picture view for the risk management committee or your management to look at. So here we look at the activity under business lending, and it was broken out some different areas. One is the underwriting, other is the collateral valuation, and another one is collection practices. Collateral valuation and collection practices, they said the aggregate risk is moderate and the risk direction was stable. This here under the credit underwriting, they said the aggregate risk was high and the risk direction was increasing. So this had moderate risk, if I remember, but the risk management practices were low. And there was a reason for that. If you look in comments, first of all, there was a big change in the lending team and leadership over this business lending. There was a change in the volume and complexity of the deals, and the regulators had some findings. They had come in and done a review of some loan files. So that's why the aggregate risk was high. And because there was a change in the lending team and the increase in volume, the risk direction was increasing. So let's look at another example on this. This is loan administration. We have loan review, which was fine, moderate risk and stable, and loan monitoring, which was moderate and increasing. Now, one thing I should talk to you about is how do we measure the amount of risk? Usually it's going to be the amount of money you can lose, to be quiet, if you could quantify it. So here in loan monitoring, this was moderate risk, but the risk direction was increasing. This is because they had some new procedures that were being implemented, and there was a hot button for the regulators. So overall, you're going to have it could be a higher risk area underwriting, because if you don't underwrite your loans correctly, if you don't assess the risk in your loans, right? If you just maybe have an application and you give money to anybody who applies because you don't underwrite any loans, right? Let's say there's this institution and I apply and you just give me a loan, doesn't matter. They don't check credit reports. They don't check any my cash flow, my income levels. That is, you can lose a lot of money. So it's important with credit underwriting that you have the credit policies and standards and templates in place to do an assessment of the person, of the business, if they're going, or the company, if they're going to be able to pay the loan back. That's why it's high risk. With loan monitoring, the money is out the door already, right? You've made the credit decision, you've closed the loan, you've given the money out, right? There's risk if you don't follow up with the loan, with the borrower, if they don't pay, right? You want to collect your money. And if I stop paying after 60 days, or let's say I stop paying and then you don't contact me for like 6 months, and then you find out I've moved somewhere and you can't find me, well, then we can't get the money back, right? That's why it's important to have loan monitoring. However, it's not maybe the underwriting, the assessment upfront of the ability for me to pay that loan is a bit more important and in higher risk than the loan monitoring. But here again, loan monitoring, the moderate risk, because this institution had practices in place and policies in place to follow up when people didn't pay their loans. However, this was a hot button for regulators. So the institution the management saw that this risk was increasing, that we wouldn't adhere to what the regulators were saying. Okay, So the risk matrix problems and issues, they're not reviewed enough. Risk isn't static, it's changing continuously. So when I go in and I develop a risk matrix with institutions, my worry is when I walk out the door, it's never looked at again. And my hope is that it's looked at quarterly and it's changed and it's discussed. The other problem is it's not presented clearly and not supported by information and data. So again, you know, one other problem we have is, and that's this kind of ties into number 4, the responses are not honest. Nobody in an institution, usually a department head, wants to admit they have increased risk in their institution, in their department or their unit. So it is, you know, the risk committee or the executive committee needs to push each other and talk with each other and admit where the risks are. If you're doing a new MIS system, guess what? The IT risk is increased until you've implemented that new IT system and you've tested that IT system. Now, I just went through this with a financial institution that the IT manager did not want to admit the risk was increased, but it did until the MIS was implemented and it was tested, and we felt secure that the financial statements and the loan management system was providing correct data and things were all fine. Another issue is no actions are developed from the findings. So if you do have something's high risk or increasing risk, there has to be an action. Even if the action is, okay, next meeting, we need to have a report on this risk and what's happening. Has to be some kind of action if there's increasing risk or if there is a high risk area. And again, the other issue is if this is not tailored for the specific institution. Unfortunately, I've given examples of risk matrices to some institutions, and they end up just kind of putting in the same thing that I wrote from a previous institution and not thinking this through and what their specific risks are for their specific environment. You'll get a risk matrix. You can see, I think, from the area, you can tailor it to your institution, and it's not an easy task to do immediately. It takes time and talking with each individual department to figure out what the risks are. But once you have the risk matrix established, then it gets a lot easier easier. It's more efficient to be able to have a discussion on where the risks are and increasing on an ongoing basis. So as I said, you're going to get an example of a completed risk matrix that might help you understand how to complete one of these in the future. Now we are coming to one of my, favorite risk management tools, and it's actually operational risk. And it's interesting. My background is more financial and credit risks. However, I was partnered with an operational risk expert for a number of years who I learned a lot from. And I actually have found operational risk to be interesting. And probably, I will admit this honestly, of the institutions I worked with, it's probably the risk that is least monitored. It seems it's reactionary in many times and not proactive. So I want to talk to you about a risk tool that I've used that I received from this expert and that we've implemented in a number of institutions. So talking about operational risk, credit risk and market risk, financial risk are assumed with banking, right? They're very specific to banking and financial institutions that lend or take deposits. However, operational risk is everywhere. Even a store, can have this, but there's some very specific features with financial institutions. I was reading a lot of articles over the last couple of years about regulators, their complaints about operational risk. They say, that financial institutions need to think about integrating qualitative considerations when completing a self-assessment. This is what I'm going to talk to you about, is a self-assessment. And operational risk, they're always reactionary. Financial institutions, unfortunately, they should not sit back and think about, they do not sit back and just think about overall operational impact risk and the impact on the institution. Usually they're just waiting for it to happen. Such as like fraud, it usually happens, or maybe something with IT, but they're not thinking proactively about these risks. So just to be clear, let's talk about what qualifies as operational risk. Okay, so there's 7 defined risk categories. You got internal fraud, right? Theft of property or circumvention of some regulations. You have external fraud, which is theft, robbery, hacking, phishing. You have some employee practices and workplace safety, which can be breaches of employment laws. We have clients, products, and business practice risk. That's unintentional or negligent failure to meet an obligation. We have damage to physical assets, which can be natural or human-induced disasters. We can have business disruption and system failures, which is the, maybe failure IT or utility disruptions. And then you can also have execution. Oh, that should be 7, not 6. But execution, delivery, and process management, which is the failed transaction processing, such as like an accounting error. Okay, so those are, just to be clear, what is under operational risk. So my favorite tool is a self-assessment tool. So what happens with this tool is you identify the operational risk in each department of the financial institution, head offices and branches. You do a preliminary assessment questionnaire that may help, as well as you can look at also internal audit findings. So we'll talk about the questionnaire. And you do regular updates or reassessments based on incidents reports received from branches and departments and further input from the internal audit reports. So again, you do this once, but then should be looked at quarterly and reassessed. And you can look back if there's some incidences that have happened, because hopefully you have some operational incidents reports, or maybe from your internal audit reports. So let's go through operational risk assessment. There's 5 areas, main 5 areas, and you're going to get this Excel worksheet. There's administration, finance, human resources, IT, MIS, and operations, including branches. Each department will develop a list of risk areas. Then the risk committee or risk person reviews this. There's rating areas. So what happens? Those are the units that looks at the risk. But then the risk areas are an inherent risk. What are the mitigating factors? And then you decide on a response. So again, these tools, the matrix, and also the self-assessment, they're only as good as what your response is going to be. So you can accept the risk, which we will talk about this, or you can manage, control it, you can share or transfer it, or you can avoid it, insure it. But there has to be a response to the risk if it's a higher, medium, or high risk. So let's do a couple examples. Oh, well, first of all, here is a section of the risk register for the IT. Okay, so as you see in the first column, there's a description of the risk. Okay, if we look at it's the first line, users of IT systems may fail to keep their user IDs and passwords confidential. Question is, this is a risk. Are they sharing passwords? Okay, so in this institution, it was very likely. We found out when we went out to branches, this was extremely common. And we said that this was critical because people were making changes in systems and it wasn't the person whose idea it was. So the inherent risk, if you add the 5 plus 4 is 9. And if you look up on the top, that's a critical risk. Okay. If we look down at number 3, bank may not have sufficient desktops, laptops to enable staff to provide efficient services to their customers. The likelihood was low. This bank actually provided the majority of their staff with sufficient equipment. And the impact, let's say if somebody didn't have a desktop for a while, was moderate. So the inherent risk was a 4, which was low. But let's go ahead and I'm going to show you a couple of examples of some institutions I worked with that looked at one risk quite differently. Oh, sorry, we're going to talk about this inherent risk rating. So what happens is the likelihood of the risk is on the left and the impact risk is on the right. And as you can see, when you add these up, the likelihood plus the impact, you get a heat map that will show you what is low risk green, medium risk yellow and orange, and high risk is red. So you'll also get this heat map. So let's talk about IT system hacked. And these are two banks. We have Bank ABC and we have Bank XYZ. So ABC said the likelihood was 2 to be hacked. The impact was going to be a 4, medium if they got hacked. So the inherent risk was a 6. Okay, so it was a medium. So Bank XYZ saw the likelihood more likely because they had had hacks before, they had had issues. The impact, again, they agreed was a 4. And so the inherent risk was a 7, which actually was one step up in the heat map. So it's a orange. So it's a higher risk. Okay, so that's how these two institutions looked at it differently. ABC hadn't, it was a smaller institution, had not been hacked. And it felt like its IT systems were extremely strong. And Bank XYZ had been hacked. And even though they felt like they had really good systems in place, they felt like the likelihood was higher. So two different institutions can have two different views of how they feel like the likelihood or the impact. So the mitigating factors, you can have a score. You can have excellent is 4, good is 3, moderate 2, weak 1, unsatisfactory 0. So what are mitigating factors to this risk? If you have strong policies and procedures, you have good controls in place, you have insurance, maybe, let's say, on your vehicles or on your buildings. You could also have in results of internal audit review or an external audit that shows very good, that would show you that you have good controls. Or you can even have the results of a regulatory review that can tell you if they felt it was good or acceptable controls in place or lack of controls in place. So that's how you judge the mitigating factors. So what it is, the residual risk is equal to the inherent risk plus mitigating factors. So here's another heat map. So once you've added the likelihood from that previous right heat map, you have it rated 2 to 10. Then you minus out the mitigating factors. So it's actually inherent risk minus the mitigating, it shouldn't be plus, minus the mitigating factors, right? So then you would have, so let's say something is critical, it's 10, but you have excellent mitigating factors and controls in place. Then it reduces the risk to a 6, okay? However, if we look over and you have a critical risk that's a 10, but weak controls, then it's a 9, which means it's a high risk. So that's how you look at it. So let's go back to our examples. Likelihood of ABC was 2. Remember, then we added the impact 4. It came to a 6. However, they felt their mitigating controls were very good before. So the residual risk was too low. Bank XYZ, as remember, thought the likelihood was a little bit higher. They thought it was a 3. Impact was a 4. Inherent risk was orange, was a 7. They thought their controls were okay because they're trying to upgrade, so it's only a 2. So their residual risk was actually a 5. And they were going to implement some extra controls and an extra IT audit because they felt like they had too many hacks, and not that they had lost any significant money, but it seemed like the occurrences was happening more and more, that there was actually some breaches. So, and they had one instance where they actually had to close down the system for a while. So that's why their residual risk was a 5. And here we go at the bottom, which you will get it tells you where the risks are. And this risk for the IT, for the 5, is moderate, whereas the residual risk for ABC Bank was 2, which is low. So again, one of the most important features to both of these tools we're talking about today is that you have to have a strategy. You either accept the risk, you manage it, control it, share or transfer, or you accept to insure, okay? So let's give an example. I'm going to talk, this just happened last month. I was working with a financial institution that's very small and only has 1 person working in human resources unit. That handles human resources, also has to complete a bunch of paperwork for payroll. Management and the board decided that the risk of having 1 person, because it was a high risk, but they said, we're going to assume the risk because to hire an additional person is not cost effective. And we don't want to have to hire another person in this department when it's not needed. However, they said, we're going to mitigate some of this risk because we're going to train 2 people in the finance department how to handle the payroll so that they could be able to handle it if the HR person ever left. Interestingly enough, the HR person is leaving this institution. So at least for now, they have somebody that can handle the paperwork for the actual payroll. And that was the most important thing. So by doing this risk register, I worked with them over the last couple of months. We identified this risk. We actually started training the people in finance. And then surprise, surprise, the HR person left. But at least for now, we're okay, at least to get the staff paid. So again, most important with both these tools, it's you've got to think about, do we need to take any actions? And finally, here's the dashboard example of an operational risk from an institution I worked with way back in 2014. Wow, that's a long time ago. As you can see, we rated the residual risks by departments. And we can see that, for example, let's say human resources, they had a total of 21 risks they identified. 14 were low, 6 were moderate, and 1 was high. IT, and this is where we were having the breaches in passwords and some other incidences. I think, actually, yeah, here's the critical elements. There was passwords were being shared and the rights for people's access were not being reviewed. So this was decided years ago of how much right like like one employee would have to the IT system, how much access they can have, and they were never reviewed. Those were the 2 critical elements. So one funny, slight interesting part, if you can notice, look at finance. Wow, they have 22 low risks and only 4 moderate. Well, I had one huge issue with this institution. The CFO thought all the risks in his department were well managed and well controlled. And he was as my mother would say, a tough cookie, he didn't want to think about the risks in his institution, or he didn't want to think about the possibility that they weren't being managed correctly. And that was extremely difficult to work with somebody like that. We were able to get this changed a bit, and it took the risk committee talking about and saying, hey, maybe there's some higher risks there. Maybe there's some other things we need to think about to get this person. So again, the departments can look at the risks, but then it has to be discussed at the institutional level, either in the risk committee or at the executive committee. And then there has to be pushback. There has to be the risk committee, the members of the risk committee or executive committee have to be comfortable to challenge each other in an appropriate manner to say, hey, maybe there's some higher risks in the finance department. How about this or how about that? Because this tool is only as good as really thinking this out and getting the right understanding of the risks and the mitigants. And that's it. Thank you. I will let Nathaniel take it over and see if we have any questions at this point. I'm going to take a sip of my tea.
Okay, thank you, Donald, for an awesome presentation. Please, I encourage you that if you have questions, you can submit them onto the chat box, and then Donald will address as many of them for us as possible. Okay, Donald, a quick question though. So, based on this risk appetite that you're saying, who developed the risk appetite statement? Can you clarify for us who developed the risk appetite statement?
Yeah, the risk appetite statement. So, I mean, it should, it should come from the board, but does the board have the time? No. So a lot of times it'll be within the risk department or a risk, the chief risk officer will work to develop it with management and then go up to the board and then work to finesse it to get it agreed upon by the board. In the perfect world, the board has sessions where they'll actually go ahead and develop the risk appetite. That's in a perfect world.
So you recommend that the statement be developed by the board?
In the perfect world, but sometimes it has to be pushed up from the risk committee or the risk person in the bank or financial institution.
Thank you. So please, if you have any question, you can post it in the chat box and then I'll ask Donna for clarification. Okay, Donna, there's a quick one here. How do we deal with clients who have taken multiple loans, but credit investigation depicts that they are paying the loan well? As an institution, do you go ahead to disburse such a client?
So if I understand the question right, Nathaniel, they disperse multiple loans to a client probably outside of their tolerance levels. And now the question is, this client's paying everything fine, but should we accept this if it's outside our tolerance levels?
Could you say that credit investigations depict that they are paying the loan so well, which in natural sense means that they are not paying such so well. So
they're not paying it well. They're not. So we've given multiple loans and they're not paying it all on time. Is that correct, Nathaniel?
Yeah, that's good.
Okay. Okay. So, I mean, that's so there's two things here to think about. Parallel loans to a client is risky, right? Usually it's better just to give one-to-one to monitor, but all the institutions I've worked with everywhere allow for parallel loans to an institution. If they stop paying, they stop paying. If I understand it, then they're delinquent, and you've got to look at the problem is I've seen is if they're paying one loan on time they have, but they're not paying another loan on time. How do you risk rate and look at both loans? We downgrade both loans because we think if they're continuing paying one but not the other, it's a high risk that they're not paying that other loan. The bigger issue is if they've breached it by getting more than the number of loans they should, and they're paying on time. So they look like a good client, but they're not within our risk tolerance levels. That's hard because I've come across that where loan officers and lending departments push back on me as a risk person saying, hey, okay, yeah, they have more than loans than they should have, but look at them. They're good clients. They pay on time. There's a reason we sent these risk tolerance levels, and it's for the safety and security of the financial institution. And unfortunately, we have to adhere to it, even if we give $1 million loan to somebody who's paying it on time. But however, let's say we only allowed to give up to 20,000 to a loan. We just can't do it. We have to stay within the risk tolerance levels of the institution, the risk appetite.
There's a follow-up question that says that what's the difference between risk appetite and risk tolerance? What's the difference between the two?
Good question. So risk appetite is what's acceptable to us, and it bumps up to the tolerance levels, right? You never want to go over to be intolerant, right? So the risk appetite, here's like our risk appetite of what we accept, okay? It's like green, right? And then it gets to a tolerant level, and that's like yellow, red. So the risk appetite is what we accept up to here. And then the tolerance, right, level is here, and you don't want to go above it.
Okay. From Afi, it says that when people refuse to pay the loan and have relocated and cannot be traced, others have Others have agreed to pay but are not paying. I don't get the question. Can you please reframe the question? But as we wait for such the reframing, it says that does an organization really need a risk appetite statement if it has a mission statement and key risk indicators?
Yes. So people can get a little bit confused. So a mission statement, a risk appetite is showing your risk tolerance. Like I said, mission statement is more aspirational goals. So as I said before, risk appetite should never be aspirational. It should be what we accept in our risk appetite, right? The mission statement is what we want to become and what we envision in our plans and goals and our purpose. Okay, so they're actually quite different.
Okay. Thank you so much. Another question that is in is, what is the reason for the risk matrix and who uses it? What is the reason for the risk
So
matrix?
it's the risk matrix actually is like, it's kind of a high level view of risk at an institution and understanding what the level of risks are and where the risk is going. Okay, so this is why it's a tool that's used at the risk committee or it's used at the management committee. It's not like you don't want to go too granular. You're going to see when you're going to be able to download it from Gomfi's website, and you're going to see it's only, I think, even just 2 pages long. And it's like these big overview of these areas and deciding the risk, the amount of risk, and then what kind of risk management practices we have. So it's a very good overview tool for risk management committee or for senior management.
Okay. Thank you so much. A follow-up question from the audience. It says that, how does a microcredit measure its loan at risk? How does a microcredit measure its loan at risk?
Okay, so portfolio, we call it portfolio at risk. And what it is going to be, so let's say I hit my head. I take a loan for 2,000 SOMs. Okay, let's say 2,000. And I pay, that's 2,000 principal, and then there's interest. I pay the principal down to 1,000, right? So if I'm looking at what portfolio risk, it's the 1,000 outstanding over the entire amount of the portfolio. So let's say I pay it down to 1,000 and I stop paying and you can't find me, I've gone and hid it. That 1,000 of principal that I haven't paid is divided by the total principal outstanding. So let's say we have 10 loans, they've all paid down to 1,000. So the portfolio outstanding is 10,000. I'm the bad person. I stop paying at 1,000 principal outstanding. It's 1,000 divided by 10,000, the principal outstanding. So you have 10% portfolio at risk. And if it's over 30 days, let's say I'm 35 days late, you would say it's 10% over 30 days late.
There's a long one, yes. I'm trying to read it. Say that in time of economic hardship, like what is happening in Ghana now, as an institution whose main source from income is purely from lending, do you continue to disburse loans, or you suspend your operation for some time, which doing so also affects the business because you have operation costs to bear? What do we do about such a risk?
You know, suspending and stopping lending should only be done in very dire circumstances, right? And I've only seen it done. Some institutions did it on the onset of the pandemic. They stopped dispersing. I've also seen it with my one institution I worked with in Bosnia that was in a crisis situation. We stopped 2 new clients. We would relend out to previous clients. Yeah, but stopping lending is also reputation risk then, because then you get a reputation in around the market that you've stopped lending. You tighten your controls. That's what I would do. If, there's a hardship now, maybe there's got to be some extra controls, maybe some extra guarantees or collateral that you got to tighten your standards, right? To see who can actually pay it out. Maybe you make smaller loans, maybe you tighten some things, but stopping lending, I mean, that is a harsh thing that will impact the institution a lot longer. But again, I think you got to tighten your credit controls and tighten your monitoring, tighten your credit controls. That's the most important thing to do right now.
So you tighten your controls and you can do possible smaller loans as compared to larger loans.
Yeah.
Okay. So another one from the attendees says, how reliable will the response to a risk tool be if the answer or response given by the staff does not reflect what exists in the firm? Yeah.
Oh, who said that? Oh, whoever said that is very on top of this. Yes, the tools are only as good as the honesty that you're going to get.
Okay.
And this is why you need a strong either risk manager or risk committee that can challenge each other and really talk about what the risks are. Or I shouldn't say or. In addition, you'll have the data, right? If all of a sudden you see a delinquent loans go up, something's happening, risk is increased, okay? So you can say to your lending department, okay, let's talk about this. Where's the risk increasing, right? Is there fraud? Maybe you had some, we say ghost loans, right? And that happened in the institution. All of a sudden we saw that we had a bunch of clients that were able to do some ghost loans. We didn't have some procedures in place. We should have. So we had some fraud, external fraud. Or let's say something happens and you have more incidences of risk, maybe IT breaches. An internal audit discusses this. Well, you have internal reports that will tell you if risk is there. So honestly, from management and the staff, however, you should have reports and internal reports, internal audit reports and other reports that could tell you, and you can see if there's some higher risk areas.
I hope your questions are being answered. If you still have some questions, you can post it in the chat box. There's another question for you that says that if risk levels are high and tolerable, but are adverse to regulatory requirements, what must be the decision point?
Regulators always are going to trump. I'm sorry. I mean, believe me, Bosnia, where I work, is probably the most regulated place I've ever seen. It's ridiculous. They regulate even, you know, these small MFIs, but you got to do it. You have to do it because they can close you down, unfortunately, or they can give you some fines. And that could, you know, hurt your income statement. So unfortunately, yeah, regulators always will trump, as we say.
Regulators we go.
Yeah.
Another question is, how often should operation and ops risk register be reviewed or updated?
So I think I mentioned this. I think it's good to be looked at quarterly. Like I said, things change on a quarterly basis, especially now. It seems like things are just changing so much in this world, much more quickly than it did when I started banking 25 years ago. So it has to be reviewed and thought about if anything's changed in your environment on a quarterly basis. It just has to be a quick discussion. And if there's a risk person, they can review it before you go into a meeting to make any recommendations, if there should be any changes.
So you agree on a quarterly basis. Thank you. Any other questions from the attendees is welcome by Donna. Another question for you is, how long does it take for an ops risk register to be developed? It seems like it takes a long time, but
oh yes. I mean, so here's the thing. I remember doing this at one institution and we handed it out to everyone, you know, at the risk committee and said, okay, you know, ops or branch operations got to look at this, you know, finance, look at this. Well, you know, every month I was asking these guys, are you working on this? Finally, I had to sit with them and go over it. So it can take time unless you have management or the board demanding this to be done. If you have something like a board or a senior management directive that it has to be done quickly, then they'll return it. Sometimes the risk person would have to sit. I used to have to sit with the IT people, the HR people, and actually go through it and develop it with them. And then the other way we made them do it is, I remember recently we made the head IT, we made him, we didn't make him, we required him to, at the next risk committee, he had to make a presentation of his risk register. So that was the way we could get him to do it if we told him he had to present it. And he did a great presentation, but just had to nudge him a little bit.
Thank you. If there is no question from the attendees, I'd like to thank you for attending today's webinar. Just like Donna said, she's giving out handouts and this webinar is being recorded and then it will be sent to your emails. We'll be sending out a presentation and a link to this webinar as well in a few days. I want to check if there's no question. So with that, we say thank you, and then we'll be closing the webinar from here. Thank you, everyone, and have a good day.
Thank you.
Thank you, Donna, too.
Bye-bye. Thanks.
Nice job again. Have a good day.
Have a good day, Lynn.
Okay, bye-bye.
Bye.